there was a cryptocurrency firm, and they were cooking the books. Nothing to do with the cryptocurrency, nothing to do with the blockchain. They just borrowed from places they shouldn't have been borrowed from and used people's money, and that wasn't okay.
Welcome in, everybody. You're listening to Wrestling Payments, a podcast where we help payment professionals contend with the challenges of modernizing their payments operations and identifying ways to build for the future. If you're interested in payments innovation and modernization, you're in the right place. Now, let's get into it.
Hello and welcome to Wrestling Payments. Today we have a special episode for you. We are looking at each month we publish at least 2 top 3 news articles. And today we're going to dive into those a little bit. So this is the listing from March 17th it's on our website. It's a member's benefit, but it had 3 great articles. So the 3 articles are, let's see. First, we're going to talk about faster payments and adoption by financial institutions, and what are some of the factors prohibiting that adoption. The next one is really interesting. The next 2 are really interesting. They're all really interesting. So the next one is Square Financial. So if you've ever maybe gone to a local dining spot, you may have seen a Square tablet there. You know, the company was using that as their register. They do a lot of that. They have, they started with the little swipe where you could anywhere attach the dongle. Yes, it's called a dongle to a iPhone and take orders wherever you were. Really, really innovative. They've expanded into lots of things. And this news is that the FDIC has approved the Square to offer small, easy-to-repay consumer loans through Cash App. We're going to talk about that. And finally, the OCC, and we've announced this previously, but again, we're going to reinforce it. It's coming. The OCC has taken a clear stance on cryptocurrency by reaffirming the permissibility of various cryptocurrency stablecoins. The OCC is paving the way. It's making it easier for Congress to say, yeah, let's have some stablecoins. So first, let's dive into all about faster payments, instant payments, using the networks, which is RTP and the FedNow service, to offer instant payment services. And I'm going to jump right into, this is an article from Payments, PYMNTS.com, their news organization puts out a lot of studies, and this particular study is under the real-time payment tracker, and the report is entitled Catching the Rails, the real-time payments opportunity for small FIs. And then it's a good read. Sometimes we get bombarded by things to read. This one's a good read because it has some results. So what's going on? The clearinghouse recently crossed the 1 billion daily payment mark, and they've upped their limit to $10 million a transaction. Separately, the Federal Reserve, which has gathered several hundred banks into its platform, so they're really having a large, we'll call it a large adoption. There are over 1,000 participant financial institutions. But the real information here is the data. So let's look at the data. As to the divide, and I'm reading, as to the divide that exists between financial institutions, consider the fact that large FIs are 6 times more likely than their smaller brethren to deploy real-time payments. That's really interesting. Will the changes in these platforms have an effect? Let's see what the data says. We have nearly 3/4, 74% of FIs with regional and national footprints allow individual consumers to send instant payments. Only 44% of credit unions allow individuals. That's interesting. Smaller mid-tier banks are coming around to the need to offer real-time payment functionality. And again, lots of the FedNow has lots and lots of participants and lots of receivers, making that move to send is a bigger move. And what is causing the hesitation? Let's see. And, you may say they're scared. I wouldn't say that. But you may say they're scared. Someone may say they're scared. Maybe not you, maybe not me. But here are the answers to why they're not sending real-time payments. 30% say that they do not have a pricing plan in place. 35% say that integration complexities are an impediment. 23% of these banks cite costs of implementation as concern. Money, so to speak, is becoming more expensive. More data. A full 80% of respondents report that inflation has had an extreme or moderate impact on deposit costs, which steer money away from the ability to reinvest in the business. The rising cost of running a bank shows that the data from the FDIC as rising deposit costs have been significant. That's most of the information here. I encourage you to go read that yourself and look at your institution. If you are a participant in either RTP or FedNow, are you offering the send option? Or have you just started as receive only? Interesting. Square. So I think this is significant. I think the idea that a non-bank is getting into banking activity is, let's call it interesting, right? It could be a crazy idea, right? Because they're not regulated like banks. It could be an innovative idea because they're where they need to be to offer loan products to consumers. What are the deciding factors? So in this news article, and we'll jump to the news article, Block. So Block is the owner of Square, of Cash App. So it's the parent. It used to be Square, but now it became Block. Their symbol is XYZ. It's not an investment report. We are not giving investment advice. But the FDIC, they've gotten permission from the FDIC to offer consumer loans via Cash App. So if you're not familiar with Cash App, it is an app that allows you to build a wallet, and then it allows you to send money to other Cash App participants. The funds can stay in Cash App, or you can withdraw them to your financial institution. If you want that instantaneously, costs a little bit. If you take it as an ACH and wait the couple of days, then it's a free transfer. I use Cash App to send money to my son, sometimes to my sister. But they're saying they keep reciting the words easy to repay consumer loans. I'm not sure what makes it easy to repay. Cash App customers will continue to empower consumer economically. Cash App Borrow is designed to provide short-term cash flow in a simple and accessible way when alternatives are notoriously expensive. So they must be talking about payday loans. Payday loans allows people to lend a short amount of money, a little bit of money, at a fee over, technically, until the next payday. Let's see what more we have in the full article. Okay, here it is. The expansion of Square Financial to offer small, easy to repay loans to Cash App customers will continue to drive the economic power to consumers. Cash App Borrow is designed to provide short-term cash flow in a simple and accessible way when we're back to alternatives are notoriously expensive and difficult for consumers to navigate. The average Cash App Borrow loan was less than $100 and approximately 1 month in duration, at a fraction of the cost of a payday loan or overdraft fees. So it's an alternative for folks who are afraid of paying the overdraft fees or even the payday lenders. The short-term credit product is available to eligible consumers who utilize Cash App and has seen strong product market fit with nearly, $9 billion in origination in 2024 offered by Block Inc. through external bank partner. Interesting. So they're already doing this through an external bank partner and they're just taking it in-house. Additionally, the vast majority of borrowed revenue comes from customers who pay on time, as the product maintains a historic loss rate of less than 3%. Customers' eligibility and maximum borrow offer are based on a number of factors, including customer state of residence, Cash App product usage and activity, and on-time repayment. So it's really interesting. This has come up in the past as, I don't know if you know, a large amount of the population could not come up with $400 for an emergency payment. People are living payday to payday. And NEACH, who offers wrestling payments, is a financial institution-based membership. So we are pro-financial institution. We've seen a financial institution in our area, New England, take this challenge up. And for their employees, they've offered that emergency loan via payroll deduction. So they understand that this is a problem. Folks not having the cash to pay their bills is a problem. And Cash App is suggesting that only a small amount may get them through to the next payday. I know with the local institution, I will call them out because it's a very public thing they've done. It's Reading Cooperative right here in Reading, Massachusetts. They have seen the problem and said, we're going to develop a solution. And I know they made the solution, the information about it, available to any community bank interested in learning about it. So could the financial institutions match the might and the power of the Cash App, Cash App borrowing? Interesting. Sounds like it could set up a world where it's even more complicated with money movement, with these private fintech companies, banks holding deposits for people. There are unbanked people out there. I think this is a really interesting article, and I think you should share this story with folks at the institution to see if there's something banks can offer. And I know banks are regulated. It's harder for banks to get through the regulation to make these sorts of solutions easily available to consumers. Like, for example, I don't know who regulates Cash App. Is it now the FDIC? Because now the FDIC had said you can offer these services. Interesting. Interesting. All right. In our final story today, we're going to talk about stablecoins. Stablecoins. I think stablecoins, we are going to see a new stablecoin in the U.S. in this year. I could be wrong. It may be early next year, but I think we're going to see them. There's lots of legislation moving. There's 3 different bills in Congress right now: a Senate bill, a House bill, and a brought up from last year stablecoin bill. All a little different. All saying regulation would be on stablecoins and limits on stablecoins. But let's see. The OCC jumped in, and they said, I guess, I don't recall reading this guidance, but previously they had said, we don't, if you're going to offer stablecoins, you can, but you got to have risk policies in place. You got to have this in place. You have this in place. They've changed their mind, if you will. I went right to the OCC website. This is March 7th release. OCC clarifies bank authority to engage in certain types of cryptocurrency activity. And what they do, this is a really short article, but you'll see, and let me get through this article. So Washington, the Office of Comptroller of the Currency, today took action to reaffirm that a range of cryptocurrency activities are permissible in the federal banking system. The OCC published interpretive letter 1183 to confirm that the crypto asset custody, certain stablecoin activity, and participation in independent node verification network, such as distributed ledger, are permissible for national banks and Federal Savings Association. The letter also rescinds the requirement that OCC supervised institutions receive supervisory non-objection. That's a funny way to say it, and demonstrate that they have adequate controls in place before that they engage in this cryptocurrency activity. So prior to this, their guidance was, you got to ask us. If you want to do this activity, you got to bring it to us and we will non-object to it. Okay? No longer required. If that's something the institution wants to do, if that's something the institution wants to do with a fintech, they are saying you should pursue that, because we are not going to object. They do, the second article, I think I remember this, they reaffirm the fact that OCC expects banks to have the same strong risk management controls in place to support novel bank activity as they do for traditional ones. Today's action will reduce the burden on banks to engage in cryptocurrency-related activities to ensure that these bank activities are treated consistently by the OCC regardless of the underlying technology. So what they're doing, I think, not to get political, there is a emphasis in this administration on cryptocurrency and making it easier for cryptocurrency firms to do business. I watched the whole hearing on how unfair banking was, and regulators were to cryptocurrency companies because they were on the bad list. So they got beat up. The regulators got beat up. They didn't get beat up in person, but the panel was a panel of cryptocurrency companies, outspoken agencies saying that they're not bad guys and you should allow this to happen. The question is, how will you participate in this? That's one question. The other question is, what do you think, what kind of effect will it have on it? Because just like I cited in the Square segment, who regulates the cryptocurrency firms? What banking authority regulates the cryptocurrency firms? We've seen crypto, we'll call it challenges. We've seen crypto challenges, and most of those weren't about the cryptocurrency. They weren't about blockchain technology. It was about business problems. We saw Silicon Valley Bank go under. Wasn't because of the crypto. It was because they made some bad business decisions, in my opinion. And this is not NEACH's opinion. But they were overinvested in low yield funds. They got a run on the bank. They ran into problems. The other one, I say it wrong all the time. There was a cryptocurrency firm, and they were cooking the books. Nothing to do with the cryptocurrency, nothing to do with the blockchain. They just borrowed from places they shouldn't have been borrowed from and used people's money, and that wasn't okay. The thing I saw, and it was just a draft bill, but I think it was the House bill on cryptocurrency. And the idea, and it was just an idea because it didn't even have a number yet. It was called it's either called the Genius Act or the Stable Act. A little play on words. I don't know if you recall, at one point, Mr. Trump called himself a stable genius. So now we have the Stable Act and the Genius Act. Both are geared to cryptocurrency. The one I was looking at was the House bill. And what it does is it puts the regulation of stablecoins on the state. The state has to supervise the stablecoin issuers. The stablecoins must be in a very liquid investment. It has to be in short-term treasuries, cash, easily liquid. If someone's looking for their funds, it has to be available to them. They were supposed to, again, this is the draft legislation, they were supposed to examine them every month to make sure that the funds in those accounts were valid, ready to use, liquid, all of those things. The backup regulator, I guess if a state said, we're not doing that, the backup regulator is the Federal Reserve. And it puts a cap on a stablecoin that an organization can issue of $10 billion. And, me personally, again, I'd love your feedback on this. I don't think that's a lot. I don't think that Not that I'm encouraging stablecoin or discouraging stablecoin. I don't think that's enough to move the needle. I think, for example, just talking off the top of my head, a PayPal could be in a position to have a bigger issue of a stablecoin. A Capital One could have a bigger issue of stablecoin that could work. But I'm not a legislator. I'm not a lawyer. These are just thoughts running through my head. The final part of that 10 billion stablecoin, 10 billion regulated every month to make sure they had enough money. Oh, if it's a financial institution, it can't be the financial institution. It has to be a separate company. To my read of that legislation. So the bank itself could not issue the stablecoin. A subsidiary could. A partner could. I think this opens the doors for a lot of activity in specifically stablecoin. And the stablecoin is intended to be a dollar, right? It's supposed to be stable. It's in the name, right? It's supposed to be stable. It's supposed to be one of the challenges we run into, even talking about FedNow and RTP. They use an international standard to transfer money, but you cannot send an RTP international or a FedNow international. If someone in Europe had a wallet that could exchange this stablecoin, and when I say a wallet, Cash App, for example, Cash App, if there was an app that folks could exchange stablecoins on, this would easily be an international payment, easily. So it's really interesting. It's really interesting from an academic perspective. Will we see a stablecoin this year? How will it work? How will it gain traction? Will it be a unique little way, like someone who, sends gold to someone? Like, we're not going to see a lot of that. Or will it be a Cash App or a PayPal app that uses this stablecoin as a new, currency? Currency. I can use the word currency. It's a cryptocurrency. I can use the word currency. It is still backed by US dollars. It is not its own, it didn't spring out into existence as its own currency. It is backed by US dollars. So with all that, I think that's a little bit of a what's in the news, what could affect our jobs in the next, couple of years. All of these things have feet and have a little bit of a life of their own. So where they end up will be very interesting. With that, always open to your ideas. If you have any questions, please feel free to reach out, and please subscribe. Please leave a little note. All of those things help the channel. Thank you very much.
On behalf of NEACH, your trusted resource in payments, and our guests, I'd like to thank everyone for tuning into the podcast. If you've enjoyed this episode and want to hear more about payments innovation and modernization, you can find the Wrestling Payments Podcast on the podcast page of NEACH.org or wherever you subscribe to podcasts. Just search for Wrestling Payments in your podcast app. Thanks for listening.